Brian Leonhardt here with the Leonhardt team at Coldwell Banker Realty. We're a team of 10 agents. Last year sold a little over 150 properties and 55 million in production. And today we have on Mr. Tony Olson of Guaranteed Rate. So he's been one of the lenders that we recommend, and he does an absolutely amazing job. Today, we're going to talk a little bit about lending and also first an introduction. Tony, how long have you been in the lending business?
I started back in 2002, so it's been about 22 years.
22 years.
Yeah.
Okay. And I know your history, right? You started in underwriting.
I actually started on the origination side. So when I
Origination.
graduated from college, I went into originating. So through Wells Fargo Financial, which is a little different animal. So we were basically handling the transactions from front to beginning, and I did that for a couple of years. Around the housing crisis, I transitioned over into underwriting. So there was a big crisis, obviously, with quality. So I transitioned with Wells Fargo into underwriting around 2007, and then around 2000, and then I worked my way up through underwriting as a lead underwriter, underwriting manager. Took over correspondent lending for Wells Fargo's conforming conventional program. And then I went to Florida and I was a director of credit policy for a company out of Florida for a couple of years. And then I came back in 2014 to the origination side back in Minnesota when I came home.
Yeah,
So I've been originating again for about 10 years.
got it. And what's the difference between originating and underwriting?
Well, when you originate the file, you're working with the borrowers at the beginning part of the transaction.
So most of the sales part of it.
Mostly the sales part, so helping them qualify, helping them get ready, what do they need, what's it going to take to qualify to buy the house. Once you get further along in the underwriting, or further along in the process, the file, as a sales professional, I can't say you're 100% good to go. I mean, our investors require that a disinterested third party that's not being compensated on that transaction reviews the file for the guidelines, make sure it meets every single criteria within those guidelines, and then issues the approval. So that's the underwriting side of things.
So you've been on both ends of the
Absolutely.
spectrum.
Yep.
How rare is that for a lender that have done both sides of it?
I think it's pretty rare. I mean, it gives me a unique set of skills that a lot of other loan officers do not have.
Believe me, I know.
Yeah, like understanding the guidelines. There's multiple different programs from conventional to government to a variety of different things and different scenarios that are not readily available. You know, like you have to know how to dig to find the answer, and you have to know what works and what doesn't work. And what I like to tell people is that I speak underwriter. So when they're going through troubles or files with the underwriter, we can usually, address those issues before we bring those issues to the client. So as that intermediary person that knows the guidelines, that knows what they can and can't do, we can tell them very quickly what it's going to take, what you need to qualify, and what we can do for them.
And I think it's such a unique skill set of when I refer people to you, it's like knowing that you have been on the underwriting side of things, knowing that you know the process better than I think any lender that I've ever met, of just knowing the ins and outs of what can work, what can't work, knowing that you have been the person that has actually underwritten the loans, right? And now you're on the sales side, and I think knowing, and correct me if I'm wrong, in the process of it, of going, what a originator does is taking your information and packaging that all together of everything that they think they should need. Then it gets sent out to a third party underwriter. They then check and verify. Then sometimes it comes back and we need this and we need that, or this, we need some of these extra things, is to go, you already know mostly what's going to happen. So you can prepare them or make sure that that package is as good as possible, because some lenders, and you work with one that's not always great, that they don't know all of the things. They may not have the right package put together or not know how to put that package together. And then it gets sent to underwriting and it gets denied, or it goes, you have 15 conditions you need to make, and it's like, well, we have to make closing on time, and we didn't prepare for all that because the originator didn't know all the things and know it well enough to know that side of stuff, right?
Correct. Yeah, that's a big part of it. I mean, having the clarity of knowing what's coming, of knowing what the underwriter is going to be looking for, what they're going to be reviewing in the package, what documents we should have in the package. It goes down to what type of income is usable, what kind of income isn't usable. goes down to looking at a property, knowing what program is going to take that property and what's not. What, you know, where do we got to take it? What avenues? When do we have to pivot? When do we have to adjust? And from being an underwriter and being in the credit policy side of things and seeing how the guidelines have changed and how they get tighter and they loosen up and they get tighter, and it's constantly, it's an industry where the goalposts seem to be moving quite frequently.
Yeah.
To stay on top of it and to be able to understand those changes in the guidelines, to be able to take your client's scenario, package it into that package that you're referring to, send it off to the underwriter, get a nice clean approval back, you know, appraisal, title, whatever outstanding conditions are there, limit the amount of back and forth and asking
Yes.
the clients for new things is a huge part of simplifying the process and not being surprised by.
And helping just like the customer service process, because there's nothing that, you know, when you think that you've sent in every document and you think you've done everything, and then all of a sudden 3 days before closing, like, oh, we also need these and we need that, we need this we need tax return from 4 years ago, whatever it is. And it's just like, I thought I already gave all this stuff, I thought we already had this ready. And how well prepared and how well the originator and loan officer understands that, the less chances of that to happen and the better experience the client has, right? So,
I mean, and there's always going to be a situation where you run into an underwriter who perceives the guidelines differently.
yeah,
So a lot of the underwriting guidelines, be it VA, FHA, USDA, conventional, they're going to vary in different forms. So to know which direction you have to take a client from the beginning is helpful, but to also know when you have to be able to speak to that underwriter in regards to your interpretation of the guideline is different than the interpretation that the industry uses, and get the proper people involved. I mean, so it's you know, we can do our best to say this is a perfect
Yeah.
file. And I don't want to say that we never come back with a
no,
condition.
of course not.
But when we do, when that condition comes back, we address it.
And know how to solve it.
And know how to solve it. And for most of the time, we're going to solve that before we ever reach out to the client. We're going to be like, okay, wait, let's speak with your manager. Hey, you're interpreting the guideline incorrectly here. This is the way it is. You know, we've got a strong file. It's supported by X, Y, and Z. And this is an approvable file. Good. We've resolved that before we ever had to go back to the borrower and say, give me your tax return from 4 years ago. That's like should not have been asked for. So that it takes a lot of the stress out of it. It takes a lot of that. We are able to, you know, get the client to the closing table on time, you know, and
With less
comfortably,
work from the client.
with less stress,
Which
less
is
work,
completely
more clarity.
different than, I mean, sometimes when it happens is, I mean, that exact opposite thing happens and they don't know how to put it all together. And I think that when it comes to, you know, the most important thing I think for us, you know, for referring people to a lender is the fact that, do you have my client's best interest in mind, right? That is number one, the most important. I will never refer a client to somebody that I don't trust, because that looks bad on me. So I think that that's so important when it's like, do you know actually the best options for this person, right? Because some lenders, you know, they may not know all of the options. It's a very complicated thing. There's 1,000 different ways that you can do it. And when it goes, I need to make sure that the lender that I'm referring can look at their situation, which maybe is a really complicated one, and know and choose the best option for them.
Absolutely.
And that's something of reasons why, you know, I refer people to Tony, is because of that. I can trust that is when it comes to, I have a client that has a difficult situation, you know, and it's like, I know and can trust Tony that Tony will do whatever is best for that client, because I don't know all the things that can happen in that. I can't possibly know all of the things in underwriting or know every situation. I know a broad base of it, but when it comes to the details and actually the income qualifications, what the tax returns look like and how that all pieces together to go, this is actually the best program for you, right? That is what you need to have when you have a lender that you trust, and they go, I am going to look through your entire situation and find the best solution for you and make sure that that happens for you so you can get what you want, is this home. And I think the amount of times we've had, you know, a file fall through with lending with someone else, right? And we go to Tony and go, hey, Tony, can you save this? And it's like, yeah, well, this shouldn't have happened. They shouldn't have included this income, or actually they do have this income, or this looks different on this, you know, and it's like, sometimes people that are really well qualified and should be able to buy a home, but something in their history or how that package is put together, or they have overtime that, isn't being quantified in that from a different lender or from a different underwriters to go, well, if we package it like this, then this will, and it will work, right? You know what I mean?
Yeah, absolutely. I mean, every lender is going to be a little bit different in
Yeah.
regards to what their guidelines are. So you have the underlying guidelines for the particular program, be it FHA, VA, conventional, USDA, whichever type of program is out there. You have the underwriting guidelines that are there, and sometimes they're very vague. Like VA, for example, uses phrases like should. They should be at their job for 2 years, and they should do this and able to use this. You should, so there's a gray area there. But then you find that one lender to another lender is going to apply their own set of overlays to that particular file. So, like, for example, you speak with different clients, they're like, well, they went to their lender and their lender says you have under a 630 credit score. We have no options for you. That's what's an overlay. So, FHA will let you go down to 560. And I'm not saying every 560 credit score is going to qualify, but those options are available within the FHA program. So we look as a guaranteed rate, we look at that as a more holistic, let's look at the entire file. Does this make sense? Can we approve this 660 credit score? Have they been at their job for a long time? Are there attributes of that file that can support that? And can we document that and make it a viable deal? So back to that is that every lender is going to look at things a little bit differently, and depending on what your scenario is, you want to work with a lender that pretty much underwrites to the guidelines and limits their overlays. And if there are overlays that they are putting on, knowing when and where you can address those overlays and use discretion or exceptions to overcome those overlays. So that's what an underwriter does. And an underwriter is trying to look at a holistic file and really, at the end of the day, is this file going to make sense? Are they going to pay? Are they going to be able to pay this file? Are there any external circumstances that is helping us? Is there a spouse that works but is not on the credit application with them? Is there other household income? Is there a part-time job that they've only been at for 6 months and maybe can't use that income, but it's a strong compensating factor to help approve that file? So, I mean, knowing those ins and outs and being able to present a provable file to the underwriter is crucial, and it helps with our success rate on getting loans to the closing table.
I think when you hear about the success rate and, one lender doesn't approve it and you do, I think sometimes the fear of, the general public is like, okay, we've heard this story before. This happened in 2005. We're just getting loans to go through for people that don't qualify. Is that what you do? How different is that now compared to what it was? And with the people that get through to go, hey, we're just trying to make this file work, right? How protect are those people to actually make those payments for that house?
They are protected. I mean, we have some of the most stringent underwriting guidelines in the industry. So people worry about, the housing crisis and the things that were caused. Those were bad underwriting standards that were being used. So it was a wild west of let's close as many houses, get as many people in houses as possible, because houses just kept appreciating. Just the value of houses kept going up. It didn't matter if, they couldn't make the payment. We'll take the house back and we'll resell it for a profit anyway. So it didn't really matter up until the point when house values started to slump. And when house values started to slump and come back down, and then the amount of inventory on the market way offset the amount of demand for new houses, there's all kinds of dynamics to that as well. But when that started to happen, and then all of a sudden foreclosures started to become prevalent, then the dam started to bust. And then, prior to the housing crisis, they were approving things like no income, stated assets. If you had a credit score, maybe one trade line, it didn't matter. If you were, and I don't want to pick on any particular industry, but if you were self-employed and you said, I make $10,000 a month, well, you might have $10,000 in gross sales a month, but there's also expenses associated to that. So on your application, you made $10,000 a month. Yeah, you can qualify for a $600,000 house. But in reality, all those guidelines, when the housing crisis and the amount of foreclosures and things that happened in the 2007, 2008, 2009 time period, they totally redid all the guidelines. So your stated income, stated assets programs gone to the wayside. I mean, they've instituted some very rigid guidelines in regards to borrower's ability to repay the loan. So even if somebody has a 560 credit score, and I'm not saying we do a lot of 560 credit scores, 580, sure, they could do minimum down and things like that, but the credit quality standards is, if you're going to have, there's basically 5 criteria of underwriting a file. There's 5 things that are very important to a lender that they're going to look at every single time. They're going to look at your credit, they're going to look at your capacity, they're going to look at the collateral, and they're going to look at your capital, so your assets, and they're going to look at the other conditions surrounding the file. So there's 5 C's. First one's credit. Does this person pay their bills? So if they've got a 560 credit score, obviously there's been some struggles there. But if the capacity's strong, they've got a solid job, they've been at that job for 5 years, and the capacity's good, they make good income, they have limited debts, the capacity's strong. As long as the other 4 C's of the 5 C's make sense, you can get by with one of the C's not being there. So the credit could not be there, but you need strong capacity. You need strong collateral.
You had mentioned a little bit earlier on, hey, houses were appreciating in value. There's a bunch of them. It doesn't matter if they can make the payments. We'll just take the house back. Now, how is that not very similar to 2019, 2020, 2021, where houses appreciation went skyrocketing and everybody was trying to buy a home? And how is that different now than it was then?
So the supply and demand dynamics was way different back in that time frame. Builders were building houses.
But even past the supply and demand, when it comes to originating loans and underwriting, that's what I think of going, in 2005, 2006, with depreciation times, like we'll get as many of these done as we possibly can. Now, I feel like the general public also thinks that, in 2019, 2020, housing prices are skyrocketing. People are assuming that they're paying more than they can afford. And it's like, why won't the lenders just do the same thing as they did back in 2005? Because it's heyday for them, right?
So the credit qualifying in 2020 and 2021 was some of the strictest credit qualifying ever.
Really?
Ever. Those were the hardest times because of your fact that you had a lot of fluctuation going on in the market. So the value of the bonds, and if you were any time around from when COVID hit to when COVID ended, the bond market was going like this because there was liquidity issues. There was margin calls because the values kept changing so quickly, and the companies were potentially going under. And so, anyways, they really tightened down. I mean, we had to really be very well qualified to get through that turbulent time. So it's not that it was wild, wild west because, more units were sold because of super low interest rates. And affordability was beyond better than it had been in 40 years. Like you could buy a house with a 2 or 3% interest rate and your payment was fairly affordable. So that the underwriting guidelines did not loosen up.
They got tighter.
They got tighter. They got harder to make it through that process, and it was difficult because the market was faced with this huge volume influx, and there wasn't the capacity of employees.
So we have to make sure that these are protected as much as possible. We cannot take bad buyers.
There was no bad transactions. I mean, after 2008, 2009, and they totally redid the guidelines and the ability to repay and the trade rules and all the different rules associated to making sure that loan qualifies are very rigid. I mean, to the point there's gray area there too, but they were very, very strict in what it actually takes to qualify. And yes, a lot of homes are sold, but it wasn't like they were just ignoring guidelines. Guidelines actually
I think that kind of on that one, I didn't realize that, but that totally makes sense. Yeah, guidelines did get really strict during that. But I think the other thing too of that pandemic, housing market boom was this too of like a lot of them were multiple offers and bad loans or bad buying power, those people didn't really get it. You didn't see a bunch of 0% downs. FHA was hard to come through, right? A lot of the people that ended up buying that actually won in multiple offer situations were 20% down with, really good credit. Like they just had a solid buying power, right? And those people got chosen, in multiple offer situations because it reduces the risk for the seller, right? So I think if anything, the strongest people in the market, really, when it comes to a buyer standpoint, were the people that did buy that because their interest rates were super low. It was really hard to get a home, so you had to have really good credit, you had to have really good down payment, and it had to be really affordable for you. I think it's the exact opposite of what it was like in 2005, because there was a ton of supply, and it was like, well, we'll take anything anybody that'll buy. In 2019, 2020, and 2021, lenders had stricter standards because they had to, because there's so much risk in the marketplace. And then also buyers had to be really well qualified to get their offers accepted. So that is a complete exact opposite of what I think a lot of people think of, like, housing prices went up a ton. I guarantee buyers can't afford this. How can they? Prices are way more. It's like, well, look at how strict, it's more strict right now, or was, in that time. And then also, they had a really low interest rate. And to be able to actually get that home, you had to have pretty good down payment. You had to have, all the things had to look really, really good in there.
For sure. Well, it had to work on the dynamics of the sales side, on like the real estate side. To get that offer accepted, you had to be that pristine buyer.
Yes, you did.
Ability to waive inspections, ability to waive appraisal, put appraisal guarantees. You had to have that flexibility. That has now since changed with the increase in interest rates that we were experiencing.
Mm-hmm.
I mean, the Fed has raised interest rates from 0 to 5.5 over the course of a year. I mean, and it's pretty much put the housing market into a screeching halt. But we're still seeing that the amount of available houses on the market is still very limited. What they call the golden handcuffs are sellers that are out there that have these 3-4% interest rates that are like, man, it's really difficult for me to go out and to move up, even though their family has grown.
Mm-hmm.
They need more room. They need more bedrooms.
Trust me, Tony, I know.
I mean, right. But then you go and where the traditional market would have gone, and this, maybe the starter home hands off to the next generation. They move up to, $300,000-$400,000 home, and then that buyer moves up to a $500,000-$600,000 home. The move up buyers kind of froze for many years because the golden handcuffs are there. So with interest rates where they're at, it became very difficult for sellers to look at it and go, does this make sense for me to sell my house if I have to go from 4% to 7%?
Mm-hmm.
I mean, we touched 7%, we touched 8%. At one point when we were kind of towards last fall, I mean, we touched 8% as the average interest rate. It's come way back down now, which is very nice, and it's helping open things up. But the dynamic between the type of financing that's now getting approved. So for, if you got buyers out there that, maybe need that FHA loan to qualify, maybe they need down payment assistance help to qualify, they're able to still buy that house because there's a bunch of people sitting on the sidelines. So when that house becomes available, there's still a demand for it. There's still maybe multiple offers. It might not be 20 offers like we were getting back in the pandemic, but there's still 3-4 offers, still competitive. But those offers that are FHA or down payment assistance, or those ones that might have just been passed over during the pandemic, are now getting their houses accepted. I mean, the shift to some of those other programs is huge, and it's great. Affordability is still tough because we're still at a higher interest rate. But the opportunity for people to win the house now, and you can always refinance your interest rate later. So the main thing that you got to get the message across to clients is that this is the time, when interest rates are high, where you're going to be successful in winning your offer, on getting into that house. We'll wait a year or 2 years to take you from 6-7% down to 5 or whatever. The market will come back, and we are projecting that it will come back. Probably towards the latter part of the year. But for anybody that's going to sit on the fence and wait for interest rates to come back down is going to be fierce. Is going to be faced with fierce competition again. You're going to be faced with tons of people. So the golden handcuff rule that we think is that when we see that interest rates come down to maybe 6% or 5.5%, it's going to kind of release that golden handcuff. It's going to release the people with all this built-up demand that want to list their houses, but just haven't been able to make that leap. It's just been too far. And then once it gets to maybe, say, 5.5, then they're going to see like, hey, I can trade in my 4% mortgage for 5.5 because I can refinance when it gets back down to 4%. And then they're going to list the houses, and then it's going to kind of free up the inventory problem that we've been faced with right now. But people, you hear news media that, oh my gosh, the next housing bubble is here. no, we're so far from anything even close to us that's looking at like a housing bubble. You're just reading that because they're selling ads to you, right? It's just the media trying to scare you. There is no housing bubble. Houses appreciated last year from like 5 different sources, anywhere from 5 to 7% in 2023 is what the numbers are coming in at. Predictions for 2024 is another 5 to 6% in appreciations year over year. There is no housing bubble. I mean, it's just a falsehood. So when it comes to buying a house, today is the time to buy, not when interest rates go to 6%. Today, get in there now when you can win the house. So that's just
Totally agree.
yeah.
Tony Olson here from Guaranteed Rate. Thank you for taking the time to be on this and sharing your knowledge with us. When it comes to working with a lender, make sure you have somebody that you can trust that has your best interest in mind. And Tony is a guy from experience of me personally buying a house through him. He will do that. Easiest way to do it is to go online at guaranteedrate.com, search Tony Olson, or just Google Tony Olson, and in there is an apply now. You just click on that button. It'll take you 10 minutes. It's just a soft credit pull, and Tony will help you understand when you're ready to buy, if you can, and the best solution to getting you a home or understanding your situation. So, thank you.
Thanks for having me.